Section 4A, Importance of Cash Flow Analysis. 4.1 Financial Decision Making. Cash flow analysis plays a significant role in assessing a company's ability to meet financial obligations and support growth initiatives. Here's how cash flow analysis helps in these areas. Meeting financial obligations. Cash flow analysis enables the evaluation of a company's ability to meet its financial obligations, including debt repayments, interest payments, and other fixed expenses. By analyzing the cash flow from operating activities, decision-makers can assess the company's ability to generate consistent and sufficient cash flow to cover these obligations. Debt servicing. Cash flow analysis helps determine if the company generates enough cash flow to service its debt obligations. It ensures that the company has adequate funds to make interest payments and repay the principal amount according to the terms of the debt agreements. Fixed expenses. Cash flow analysis also helps assess whether the company can cover its fixed expenses, such as lease payments, insurance premiums, and utility bills. It ensures that the company has sufficient cash flow to meet these ongoing obligations. Supporting growth initiatives. Cash flow analysis is instrumental in evaluating a company's ability to support growth initiatives, such as investing in new projects, expanding operations, or acquiring other businesses. It helps determine the availability of cash flow to fund these initiatives without compromising the company's financial stability. Capital expenditures. Cash flow analysis assesses the company's capacity to finance capital expenditures required for growth, including investments in property, plant, and equipment. It ensures that the company can generate or obtain sufficient cash flow to cover these capital outlays. Working capital. Cash flow analysis helps determine the company's ability to manage its working capital requirements, such as inventory, accounts receivable, and accounts payable. Adequate cash flow ensures that the company can maintain optimal levels of working capital to support ongoing operations and growth without facing liquidity constraints. Financing growth. Cash flow analysis provides insights into the company's ability to secure external financing, such as loans or equity investments, to support growth initiatives. It helps assess the company's ability to generate cash flow to service the debt or attract investors based on its projected cash flow generation potential. By analyzing cash flow, decision-makers can assess a company's financial capacity to meet its obligations and fund growth initiatives. It ensures that the company has the necessary cash flow to support its financial health, maintain liquidity, honor its commitments, and pursue strategic opportunities for sustainable growth. Cash flow analysis plays a crucial role in the budgeting and forecasting processes of a company. It provides valuable insights into the expected cash inflows and outflows, helping decision-makers effectively plan and manage the company's financial resources. Here's how cash flow analysis is used in budgeting and forecasting. Budgeting. Cash flow analysis is an essential component of the budgeting process as it helps in determining the expected cash flows for a specific period. By analyzing historical cash flow data and considering anticipated changes in revenue, expenses, and working capital, decision-makers can project the company's cash inflows and outflows for the budgeting period. Revenue projections. Cash flow analysis provides insights into the expected cash inflows from sales, considering factors like sales volumes, pricing, and credit terms. It helps in estimating the timing and amount of cash receipts from customers. Expense planning. Cash flow analysis assists in estimating the timing and amount of cash outflows for various expenses, such as salaries, rent, utilities, and other operating costs. It helps in aligning cash flow requirements with the budgeted expenses, ensuring that sufficient cash is available to cover these costs. Working capital management. Cash flow analysis helps in budgeting for working capital needs by projecting the cash flows associated with accounts receivable, inventory, and accounts payable. It ensures that the company maintains an appropriate level of working capital to support operations without facing cash shortages or excessive cash tied up in working capital. Forecasting. Cash flow analysis is also valuable for forecasting future cash flows, enabling decision-makers to anticipate the company's financial position and plan accordingly. By analyzing historical cash flow trends, market conditions, and expected business developments, decision-makers can forecast cash inflows and outflows for future periods. Scenario analysis. Cash flow analysis facilitates scenario planning, where decision-makers can assess the impact of different scenarios on future cash flows. By considering factors like changes in market conditions, industry trends, and strategic initiatives, decision-makers can evaluate the potential cash flow implications and adjust their forecasts accordingly. Capital expenditure forecast. Cash flow analysis assists in forecasting the cash flows associated with future capital expenditures. It helps decision-makers estimate the timing and magnitude of cash outflows required for investments in assets and expansion projects, supporting informed capital expenditure planning. Cash flow sensitivity analysis. Cash flow analysis enables sensitivity analysis, which assesses the potential impact of variations in key assumptions on future cash flows. Decision-makers can identify the most critical variables affecting cash flow projections and evaluate the sensitivity of cash flow forecasts to changes in those variables, by incorporating cash flow analysis into the budgeting and forecasting processes. Decision-makers can better anticipate the company's future cash position, identify potential cash flow gaps or surpluses, and make informed financial decisions to align resources and optimize financial performance. It provides a more comprehensive view of the company's financial outlook and enhances the accuracy and reliability of budgeting and forecasting activities.